Welcome to the Cred Report. For the last 18 months, rents have essentially been flat. And right now, when we're looking at credit stress in the market, specifically multifamily, that credit stress is higher than it's been since the great financial crisis. All at the same time, we're entering into peak leasing season, that time of the year when most individuals are looking to sign that lease. Leases are expiring and move-ins are starting to happen. And in that period where we've had slow growth, everyone is kind of waiting on bated breath, waiting to see if we're going to see a return to a stronger leasing season, household formation, and hoping that some of the general macro uncertainty has created a numbing effect and folks still are moving out and signing new leases. We're going to talk about all of that and more today with Griffin Haddad again joining us, co-hosting the Cred Report. Great articles, 3 reports we're going to take a look at. One from Yardi Matrix. They've got their February 2026 national report that we're going to review. We also have a report from Cred IQ, where we're seeing the special servicing rate hit 11%, the second high since the great financial crisis. And then from Rent Cafe, we're talking about Gen Z. They're buying homes, some of them slowly. We're going to look at where Gen Zs are renting, where they are buying, what that means for the multifamily. And again, if you are interested in the jargon, in the terms, we've got a great episode, great term on the jargon bin that we're going to talk about later in the episode. You're going to have to stick around a little bit. It might not be at the end, but it might not be at the beginning. We're going to be talking about yield. What does yield mean? What does yield mean to us? And maybe it's not the most loaded term, but ask someone what yield means. They'll give you a couple different responses. All of that and more. Stick around. Like this episode. Make sure you're following Great Capital on YouTube and elsewhere. Let's jump right into it. All right, welcome back to the Cred Report. Griffin, joining us once again. How you doing this week? How you doing, Griffin?
Took a week off, well rested. Voice was getting a little hoarse. You had to replace me.
I did. I know Addison came by. I needed his insight on what's going on in the acquisition market. But I mean, you were in Florida, but you were still on the clock for a big chunk of the time.
I was working.
That's
I was
right.
very much so working. I think it's nice.
You were working, but I mean, I don't know. Obviously we've talked about what you were doing with me, but
yeah,
you're playing golf. Talking with folks, interesting people. Sounds like a good time.
Creating collisions.
There we go.
With folks that are equipped and capable to be prospective partners of Great Capital, but also share an interest in the game of golf. So trying to, just create as many collisions as I can, introduce Great Capital, introduce Griffin to as many people as I could. Was a target-rich environment, but also could see that group of guys that I ended up playing golf with, being really quality contacts across, my lifespan, if not even into creating resources and opportunities for Great Capital to learn and expand, because there were professionals there that were currently in commercial real estate. There were professionals there in wealth management. There were individuals that had several, previous successful exits, founders of companies, basically individuals with disposable income, with also the freedom of their own time and their own calendar to go out and enjoy a game of golf. And so just the amount of perspectives and opinions and experience that were there there's only 24 guys there. So small group, but very well-rounded and very experienced group. Thanks for letting me go down there and do that.
Yeah.
It was not an exercise in futility. I think we spread the word about Great Capital in Midwest multifamily.
So you're such the perfect person to be doing that kind of long-term business development, really relationship development, work, for the Great Capital team. It's a very natural skill that you have. You can go into a room and feel very comfortable, and you can just strike up a very genuine conversation with anybody.
Yeah.
And if you've ever had a conversation with Griffin, and again, this comes naturally, or I don't know what you've done in the past, but you make it about the other person. It's never about Griffin. It's never about Great Capital. It's you ask really good questions about them, and it's because you genuinely care. Like you're actually interested.
Very much so.
But so when you're there, you're not there to get someone to write a check. And that people are in the office. We go to these investment conferences, and they're like, how much money did you raise? And we're like, we didn't raise any money. We're cultivating relationships.
Yeah.
There are these long it's relationship building. And it's not we're going to convince them to invest with great capital. It's we're going to build a relationship, and if the stars align, if what we're doing matches with their goals, and we can help them, that's great. And if not, that's also okay. There's a lot of value to relationships beyond just transactions. Mm-hmm. So how do you think about that long term? And then we've got all kinds of data and reports we've talked about, but this is important too. How do you think about that long term cycle? And do you see any difference between like building that relationship related to business versus just genuinely building a relationship? I don't know if there's that much difference to you.
Yeah, I don't think so. For me, you have to be inquisitive and interested in what everybody else has going on, or what they've been able to achieve or succeed in their life, or even the challenges that they've overcome, for them to generate a curiosity in what you're doing. If you step into a room and it's all about me, look at me, I did this, or my family's over here doing that, and this is what I do, people get put off by that pretty quickly. And maybe if you just do it out of nervousness or just lack of topics to talk about, but people will all of a sudden not want to come talk to you because the only thing coming out of your mouth is going to be, very self-centered or self-righteous, mm-hmm. and self-promoting. So the easiest thing to do, especially as a young guy in the room, is to be genuinely curious and show a higher level of interest in what everybody else has their hands in, or how. I think my favorite question I asked all weekend was, hey, you're down here playing golf on a Tuesday, and you said you drove about 2 hours to get here. You live in Florida. You spend the summers up in the Midwest. How and when did you unlock that freedom for you and your family? Like, tell me that story. And they start to tell that story, and then you can grab on to one or two little details and pick things that hand select those topics of things that one, I'm interested in, but two, maybe I have something to add, like a common ground. Yeah. So the Midwest was a very common theme. There's some individuals there from Chicago that snowbird or winter in Florida. Same thing with Detroit. Just finding common ground there, because the ability to generate trust in Gray Capital really starts the ability to generate trust in Griffin as a human being, and just to display and put on. It's not a show; it's just a display of proficiency in having morals. Being a well-spoken, well-rounded individual with sound experience and understanding of the world, how it works, and then ultimately in our business. And so, to initiate, and that's what this trip was dipping the toe in the water in this kind of group of individuals. To initiate those conversations, you simply cannot talk all about yourself or all about what you do for work. You need to be more inquisitive. And then when you do get asked a question, that's usually a good sign of just general interest. And so just continue on the conversation. But it starts with that personal connection, the display and the generation of trust, to then kind of along the line, maybe 6 months, a year, shorter, longer, they may display or emote an interest in Gray Capital at a more serious level.
Yeah. All really good stuff. Really smart. What were some of the takeaways having those conversations of asking that question on? How did you find yourself in position to realize this type of freedom of where you can come down to Florida or drive over from wherever you are and take a Tuesday and play golf comfortably? Because I think a lot of people, and some people who even you can do that don't do that, and so some of it's like material ability to do it, and some of it is like the will to do it and deciding and probably allowing yourself to do it. But, what did they say to that?
First, every time I would ask that question, I'd probably ask it 5 or 6 times, but they would look at me and be like, well, you're here too, and I was like, well, okay, you're right. The kind of the big takeaway was those people that answered that question for me were either hardworking, still employed, high net worth, high earners. So dentists, orthopedic surgeons, lawyers, and wealth managers that owned their own RIA or wealth management platform or firm. The other answer that I got a whole lot was that they retired early. I think the youngest number I got was 38.
Yeah.
It was just a gentleman that had successfully exited from several companies, where he basically would exit, take the proceeds, start a new company, scale and grow and exit. And it was just kind of this repeat fashion. So I think the biggest thing that I learned was just there's reward and risk. Was one of the things that a gentleman told me. And then trying to own your own time, your own calendar, and building for essentially yourself, which I thought was interesting, because I bring up my little brother a lot on here because he's probably the closest guy that I know that's trying to figure life out still currently. And we all are, but he's the guy that I see kind of doing it the most actively. So I was in Florida playing golf, and my brother also lives close by. I'm having this conversation with him about where he is in his career path and his career journey. And he's starting to notice that this hourly wage and kind of this cog in somebody else's wheel isn't necessarily going to promote him and his girlfriend's potential to have the wedding that they want to have, to own a home one day and have the family. It's clicking. It's all starting to happen.
Yeah.
And so I mentioned that because when these gentlemen were telling me, I owned my own business, I started my own company, I sold it, and I'm here. I retired at 38. I'm just taking a look at my brother, and I'm like, I wish that he could come and be a part of these conversations, because I think the sooner you can understand that, the sooner you can learn it, the more likely you're going to be playing golf on a Tuesday in Florida when I think that guy was like 43 or 44. Yeah. So I think the general takeaway was that, you have to be willing to bet on yourself and take some risk, whether you're an orthopedic surgeon, establishing your own practice, a dentist, your own practice, a wealth manager in your own practice. You have to be, willing to kind of take that leap of faith and deal with the adversity that comes. But the other thing that I thought was also just quite interesting, and this was more in the older guys that were down there, is in life there's partnerships, and you have to find the right partner to be able to do this. And so there's one guy was like, hey, I worked my butt off for years in order to make enough money to be a part of what was going on down there in Florida in this golf. But it doesn't matter if you have all the money in the world if you have a partner that doesn't let you go and enjoy the things in life that you want to enjoy. And I thought that was really interesting. I'm married into a family that my father-in-law and mother-in-law, they coexist, but they have very different interests, and they are so excited to share their interests with each other when they come back from their trips. Mm-hmm. And I equated that gentleman that told me that, or I experienced that with my father-in-law and mother-in-law. And I'm just thinking about my wife and our marriage, and we have different interests, and we love to come back and share it. But to kind of unlock that personal freedom, it does take a lot of time and energy and effort to produce the money and the ability to go enjoy those trips, but it also takes a willing and flexible partner in your life to allow you to have the time and spend your time away from them going and doing that. I thought that was an interesting take.
Yeah, no, it is interesting. It's a lot of intention, kind of knowing what you want, being intent about it, and being specific. And I also don't think they're thinking about your life and trying to really architect your own life, and not just saying, well, when I make enough money, I'll be able to do these things. Mm-hmm. But what can I set up in the there and now? And I think last week that was an example. I think for you of saying, I'm going to go down. I'm going to be able to see my brother. Mm-hmm. I'm going to be able to do a high impact event. So it's like I'm going to be like highly productive, even though it might be but you also got to do something you enjoy.
Correct.
You love playing golf.
Yeah.
And so like you can hit all three of those things, and not necessarily. Now I'm sure you probably wish you could have spent more time maybe just with your brother or more time playing golf, but being able to get the balance of a little bit of all of those things and feeling like you didn't have to neglect necessarily the important parts of your life. Maybe the only thing that maybe could have been better if Kristen could have come.
Had to leave the wife at home.
That's the only thing. But it can't be perfect, and there'll be other things. But part of that is again like how do you want to live your life, and setting yourself up, and just being a little bit intentional about it. And it's not always going to be perfect.
Yeah.
But by having a little bit of an idea behind of what it might look like, and saying, well, what if could we do something this way?
Right.
It's important.
Yeah, talking about risk and reward, there was a gentleman, he's a wealth manager, he was telling me about how, he used this as an example. He was like, you have a $1 million account with us. We're going to take out, whatever percent on margin we can get. So let's just call it $800,000 on margin. We're going to cut that into thirds. We're going to take 2/3. We're going to put that in a long position. We're going to take the other third. We're going to put that in a short position. And now you're just like fully exposed. And he's got some downside risk. It's basically a hedge fund, but I forget what the product was he had his clients in. But it was way over my head. And I was trying to understand it and hold that conversation.
He needs to bring it on the jargon bin.
That would be great. I might have to reach out to him and figure that out. But I was just sitting there thinking to myself, like, man, that's just an unimaginable risk for me personally that I would take. $1 million, 800 to go long, It just seemed outrageous. But this was a guy that was like, it's just printing money right now.
Yeah.
And I was like, okay, so, it's just cool to hear what other people have done to be successful. It's cool to hear what other people are doing to generate some yield,
Yeah.
generate some growth. And I think that network of people, and it's a network of 300 individuals. They kind of cap each event at somewhere around. There's small events. There's 8 people going to some events. There's 24 people going to other events, and so it's always a small group, which I appreciate and allows you to have intimate interactions. But only 24 of the 300 were there at this event, so there's significant more people to go and interact with and introduce myself to and to kind of learn from, and then actually, maybe potentially generate some interest in Gray Capital.
If it works out for them, works out for us.
Yeah, I'm going to try to host one of the events here in Indiana one day. See how it goes.
Can't wait. All right, I want to jump right in to get into some reports. It's been a couple weeks since we've talked about just some pure multifamily data. I mean, we talk about it every week, but we've got a new Yardi Matrix national report out for February 2026, and we want to talk about it. Couple key takeaways. Rents, they maintain their slow pace. I mean, again, as mentioned in the intro, rents have been flat for the last 18 months. Occupancy is negative year over year in the majority of their top 30 markets. Again, this is kind of at a structural plateau, as my notes are mentioning. And supply isn't necessarily easing as quickly as some would like it. Yardi revised their 2026 completions forecast up 6.4%. There's now 468,000 units expected this year. 2027 is now up 8%, and 2028 is up 8.9%. There's over 1.3 million units projected between 2026 and 2028. Now, if you've been listening to Gray Report, watching the Gray Report, this is not necessarily news to you, in that we've mentioned that while there's going to be a nice slight reprieve of supply that comes. Hold on, I'm going to go to this fancy graphic that we have all set up for us. There will be a little bit of a reprieve. That over here on this right side of supply in 2027. 2028, well, certainly below what we're going to be delivering in 2026. And we don't have the 2024 and 2025 numbers, which would almost be double this. We almost delivered 1 million units last year. So we're certainly delivering less than we were. But, we're still delivering more units than we were, just before COVID 2020. I mean, we were delivering sub 400,000 units a year, we're kind of in that 400 to 500 a unit range, which is kind of healthy. It's good amount of supply, but for operators who are looking for some maybe some rent growth, it's not as exciting. And a lot of this growth is in the same markets. We've seen a lot of supply, which is the Sun Belt, but there's a little bit of growth everywhere.
There's a quote. It's actually a full paragraph in the article. It basically just starts out. It says, multifamily conditions are by no means dire. And in the last few editions of the weekly newsletter, I've been using a metaphor of a sailboat that's essentially has its direction, but it's just kind of looking for wind in its sails.
Yeah.
It seems like we've got a fairly good direction in multifamily. As supply is looking to come down, hopefully our vacancy rates will improve. Maybe start to see some positive trend in rent growth. I saw that multifamily conditions are by no means dire, and then you kind of read into that. Lease renewals are strong. We have strong renewal rates across our portfolio here at Gray Capital, and then you start to look at the core and value add assets of the 2022 vintage with mortgages that need restructured. We're going to talk a little bit about the distress in the market, potentially a little bit later on, but I'm just curious. As we kind of look at relatively flat rent growth or slower rent growth across the next 3 years with supply just kind of lingering around some of this distressed assets. And when we get to that article, kind of just curious to, again, rehash what we're seeing in the market because it does seem like Yardi Matrix called out those opportunities in the article relative to acquisitions or restructures or recapitalizations moving forward. It just didn't seem like there was a robust enthusiasm for stabilized acquisitions or development.
I think it's challenging because, again, the data is so negative, and there's a recency bias problem of hey, rents have been flat to negative the last 18 months. And you're looking at acquisitions that took place a year ago, and LPs are saying, well, you're not getting any rent growth. Maybe you're missing pro forma. I mean, we're fortunate Flats at Stones Crossing. We've gotten some good rent growth.
Great
at the
example.
gate. Occupancy, honestly, has been slipping the last month or so, and we need to get leases across the portfolio.
Yeah.
And that's saying that transparently and honestly. But that's the whole country right now. Also, everyone is a couple hundred basis points less occupied than they would have preferred to be.
And that's a little bit more exaggerated than just your typical seasonality.
Yeah.
Okay.
Yeah. It's more exaggerated than typical seasonality. And it's a combination. We're at the low of the season, and we're also we're at the trough of the seasonality. We're also at the trough, I think, of the cycle. Hopefully. And so that is that's breeding a lot of just slower growth, a lot of competition, and where we're seeing across the board and talking to other operators in our markets and other markets, they're all kind of seeing the same thing.
Yeah.
Which is, again, occupancies in the high 80s to the low 90s, and typically in the high 80s right now is very typical.
So that paragraph finishes up with a singular sentence, and I'll just read it, but it says, economic trends signal a softness heading into the spring leasing season and raise the possibility that 2026 could shape up to be a weak year for rent growth. We talk about this every week. We're in the data every day. This is not new to us, but as we're underwriting deals, and I know, we just took a really good stab at an awesome asset, an awesome Midwest market. We were, in the best and final, but didn't get awarded the project. And you see some of these groups that are coming out and buying these assets. I would love to see their underwriting model, because I know that we are disciplined, and I know that we're thorough and thoughtful and prudent. What are these groups writing? In year 1, year 2, 26, 27, 28 rent growth. I mean, we're sitting here looking at numbers that just don't add up to go to a certain level that some of these groups are going to get awarded these deals. Would love to see it. I know you don't. I know that you don't know, but I know you also share the same sentiment of what do they see that we don't, or what?
I think
why
there
are
are
they willing
some
to take the
times
risk?
because I've been on both sides of this, of where someone has said I'm not. What did you guys see in that? And you explain, they're like, oh, we didn't look at it that way. That makes sense. And where I've looked at deals and looked at underwriting model, and it doesn't make the returns don't look good, and then I try a different strategy or look at it in a different way, and all of a sudden, okay, no, this unlocks a lot.
Yeah.
And more so than you'd think. It's like, no, we don't have we don't have to spend that on that. They're spending what? There's a better way to do it. We could cut that cost.
Right.
Hey, what if we did this? We could, there's other income opportunity. There's, hey, how can we do more with less? What are some items that can maybe move the needle, but not necessarily going to cost as much? And then all of a sudden, you can, when I look at the kind of the before and after, I'm like, okay, now we're in a better spot. Now the returns make sense. If I hadn't done all of those things, I hadn't gone through that process, we would not have been able to be competitive enough. And so there are some times where, I ask myself and I ask the team, what are we missing? What else? How is there a different way we could look at it? Is there a business plan that does make sense?
Yeah.
Is there a higher and better use than our business plan? What are we missing? And I think that that has to happen sometime. That happens sometimes. Because there are times where, again, like I said, we've seen something. Someone's like, that didn't make sense.
Sure.
And then you tell them, and that does make sense. But then there's a large component, which is, I think this is the majority. And it's a combination of the two in some cases. But a lot of the times, it's just someone has a lower cost of capital. Or it's kind of the same thing. It's just their return expectations are just lower.
Yeah.
And so if we're trying to solve for a 15, ideally 16% IRR, but the other person bidding on the same property has a 1031 exchange that they've just crush it on, and they're like, I just don't want to. This is going to save me $1 million in taxes or $5 million in taxes. Well, when you start doing that kind of math, their returns can be 60% of what we need to see,
Right.
more or less. And so they can afford to pay more and still be fine. And in an environment, in a market where there's been somewhat limited inventory, There's more inventory today than there was last year, but it's still there's also a lot of capital chasing deals and a lot of capital that's been pent up, that's been on the sidelines. And between 1031 buyers and then I think just we are kind of in an institutional space in terms of like the size of deals. The Midwest, I think we are eating the meal that we've made for ourselves in terms of like we've been talking about the Midwest for years, and it's not just us. It's also just
they've arrived.
Yeah, I mean, we've been talking about how great the Midwest is, and then at first everyone's like, yeah, whatever, true, but whatever, and then they're still saying that's fine, but it's the only region that has positive rent growth outside of the Northeast. Okay, or the coast, San Francisco. But then people are looking at San Francisco and New York, and they're like, I'm not going to go invest in California and New York and Washington and Oregon and New Jersey. Like, I'd rather not do that. And they're like, but Ohio, Indiana, landlord friendly, taxes make sense in Indiana. Like, they're like, sign me up for that. There's positive rent growth. Sign me up. Like, let's go. Eli Lilly. There's job growth. There's population growth. Why haven't we been in this state for longer?
Right. They're kicking themselves.
So there's more competition, and but there's also then you bring into the underwriting against. Could someone be more aggressive than we are? Like, there's only so much we can do about that. If someone wants to drop in super strong rent growth every year, then there's nothing we can.
Can't do anything about
that. There's nothing we can do about it.
As this is the last question I'll ask on this article, and then we can move on. But as we start to kind of look and project into the future, maybe the next 3 years, and we just keep reading articles and seeing data on slower rent growth, our acquisition strategy, I think everybody's acquisition strategy in the last few years was there's an opportunity to increase revenue just through rent growth. How much of our efforts in an acquisition are maybe shifting from increasing overall revenue through rent growth to trying to find expense cutting measures or more efficiency within our markets? So specifically the deal that I think you and I are talking about here today, it would have been our first deal in that market. We don't have a lot of efficiencies there.
Yeah.
And so it will be a little bit different than here in Indianapolis or in a market that we already have a footprint.
It's still a little bit of both. I mean, again, it's hard. Ideally, you're trying to do both. I mean, simple private equity model: increase revenue, decrease expenses. Returns go up. But when you're unsure about organic rent growth, so you either are looking at, okay, do we have to kind of force rent growth by adding value, doing a value add plan, but then you're doing that into a market with a lot of new supply. So you can throw a $10,000, $8,000 to $12,000, at a B plus, A minus thing that's 10 to 20 years old, and you're still going to be competing with brand new construction. And 10, 20 grand isn't going to make it brand new construction still. It can look really nice.
Sure.
But it's not going to be able to do all the things to make it look brand new. But the brand new stuff is they're giving out these crazy concessions. So it's just that you can do the work and you'll probably get the rents eventually, but there's a lot of noise out there in the market. And so it's hard to be confident in saying, yeah, I'll get that $250 premium when the brand new Class A is, maybe only $150 above where we're going to be, or, $200.
Yeah.
Start feeling more comfortable. So you really, it's just, there's less confidence in some of those strategies in certain markets, and every deal is different. There's nuance. Just less confidence today that you can do X and you'll get Y. But then again, there's nuance, and there's some deals where it is clear that, like, look, no, there is a gap in the market. These spreads are very wide. Unfortunately, those are the deals that get bid up because oftentimes when you start seeing it, we say this at Great Capital all the time, if we start seeing it, we don't think that we're just the special ones that can see it. We're assuming other people can see this also. Sometimes they don't. I mean, Flats and Stones Crossing, we got on top of the changes in the tax law sooner than others did. And we were more confident because we did our homework in the new Indiana tax bill. We just moved a little bit quicker, so we had that competitive advantage. Frankly, we win deals when we have some sort of just absolute competitive advantage. We either have information that other people don't have, or it's like a timing thing of where the competition is looking over there.
Right.
Or
Flats was a little bit of both.
Flats was a little bit of both. A lot of the competition that would have normally gone after it was focused on other deals.
Yeah.
And then
You're right.
SB1. A lot of our best deals at Great Capital have essentially been because of we found a quick air gap in the market and we took full advantage of it.
Right. And that's what we should be doing in our markets.
That's what we should. That is what we should be doing. I mean, we're going to share something in the next week or so that it's basically we've done a big pipeline analysis of all the deals we've underwritten and taken a look at for the last 18 months or so. And on average, where we are versus where the brokers want to be, we're basically 20% apart on average. Like our price versus their price, we're 20% different. Now we tighten things up, and we, as we learn more, maybe it's closer within 10%, but we're pretty far away on most of the deals we're looking at. Let's go. We talked about distress as being a driver. Let's talk more about this credit IQ piece, if that's all right, Griffin.
Yeah.
There's more in the Yardi Matrix article. Check it out. Make sure you sign up to the Great Report newsletter, and you'll get those sent directly to your inbox when they come out. But special servicing rates reach 11.1%. It's the second highest level since the Great Financial Crisis. Delinquency rates are at 9.3%. And again, that's the special servicing rate is at 11.1%. And distress growth has grown 148% since July 2022. Addison and I were talking about this a little bit last week, Griffin, about how, we've seen more deals that we've gone after recently that have had maturities. We've been talking about loan maturities for too damn long. I don't know. Our first 3 years. When Great Capital, we released our first research report on loan maturities. It was coming at the end of 2023. We identified it was 2 years past 2001, and and then the can has been kicked down the road every year. And then there was a little sense of, no one accused us directly, because I thought we were always really transparent in the reports of hey, this is the setup, but these are the things that could change it. It was never doom and gloom is on this date. It was this is a period of high potential stress. But I think there was a kind of a sentiment that there was a lot of doomerism related to this maturity wall, and it has largely been the curve has been spread out a little bit, or the hump has been spread out, the waves to be able to handle it one deal at a time, so the whole market doesn't have this big crunch all of a sudden. I think there's probably some more stress in the market given some of the volatility related to maybe this Iran war. I think again it could all be fine, but we're looking at. We are approaching getting this rate where everyone thought rates would be lower than they are. Everyone was expecting relief from interest rates. Everyone has been expecting rent growth relief, and the one part of the relief wish that has started to come true, but may start turning its head again, is expense inflation. Particularly insurance costs have come down. We've seen some big savings. Now they went up astronomically. So I think it's they're conditioning us to say we love our insurance, because they're we're going to increase your insurance rates by 1,000%. Yeah. And then you're putting us out of business. And then they're we've decreased your insurance rates by 60%, but they're still up double from where they were. Right. And then they're where's our thank you? And we're thank you. Thank you, Bermuda. Thank you, reinsurance, whoever. But we have had some relief on the expense side, but it's not perfect. The expenses are still way up. It's just maybe the rate of growth has leveled off, and with potential inflation, stagflation from oil, war in Iran, who knows? That's concerning. So we got these groups that basically a year ago, 2 years ago, they've told their they told the banks like, hey, we've got a great asset, it's a good location, it's just
give
been
us
whatever. I just need another year or two. And the banks were like, well, we don't want to deal with it also. Like,
Yep.
yeah, you're a good borrower. This is a good location. Like, here's an extension. Maybe you have to put in a little bit more deposit or skin in the game, whatever. But then maybe, a year goes by and they're like, okay, hey, still not in a position to refinance. But we want you to refinance, but, hey, we're going to be flexible. Just bring in some preferred equity. So, okay, yeah, maybe we wouldn't like to do this, but we'll bring in a preferred equity partner. They write a big check so we can do a cash in. Refinance, we'll use the pref equity as the cash in. Okay, that's fine. We've lived to fight another day. We're really confident that we're going to get rate relief and we're going to get some rent growth. Mm-hmm. That was a year and a half, 2 years ago.
Yep.
And that hasn't happened. And people are having a hard time paying their mortgage. And so that's where we're seeing these rates tick up. The big question is it systemic? Is this going to cause any, we know it's going to cause some pain, but any systematic pain? Mm-hmm. And then are we going to find any opportunities because of it? I mean, that's on the other side. We don't want anybody to go through pain, but this is business. There's winners and losers. We live in a capitalist society here. What are your thoughts, Griffin? You've been following it as well. We talk about it all the time.
So we've kind of lived at a pretty high percentage rate across all of these categories in the last, I don't know, a year and a half, 2 years. It seems like it should be going down, but I think these owner operators, they're just unwilling to sell, at a loss, and they're trying to hold on for as long as they can. So like you said, eventually there must be pain. Looking at their year-end 2026 outlook, Cred IQ is actually projecting overall distress rate to remain elevated from 11 to 12.5%, which just kind of continues to show that these owner operators are going to continue to kind of kick the can down the road. The lenders are going to allow it. Early on in the onset, when we started to identify all of this distress, we put together a pref equity kind of shop operation. We were trying to deploy pref equity. Yeah. All of the deals that we saw early on in the distress were ugly. They were unpalatable in the level of risk. They were essentially almost lost causes, and I wish we would have kept up with all of those deals just to kind of track those. But I'm curious, as some of these assets have kind of been given an extended timeline or a second lease on life, I'm curious as to the palatable level of risk in some of these defaults, potential asset takeovers, or if these owners will be now willing to sell at a loss, and at what discount would we be able to purchase those from. So while I'm not excited that there is pain, on the other side of the coin, and somebody that is on a firm that is well positioned with capital that is interested and ready to deploy, I'm getting impatient with this story not unfolding out in front of our eyes. It just kind of continues to linger. And so I'd like to kind of see this come to, not an end, but I'd like to see it actually come to maturity.
Nice.
And just see what happens.
Come to maturity. I agree. I mean, there's been a sense, and this is not just multifamily. I mean, this bubbles up, percolates up through the entire market. And,
right.
We never allowed the cycle to fully cycle through. We never allowed to kind of flush out the bad deals and the bad operators and the bad decisions. All those folks have been kind of told it's all right. There's this like sense that there's nothing you could have done. There's nothing you could have known. And while like maybe there's no one can predict the future 100%, but we do all have to live with the consequences of the decisions that we make. And it was always it should have been a part of everyone's risk assessment of how to finance and what kind of risk. I mean, I remember being extremely acutely aware of the differences between floating rate and fixed rate financing. It's my first couple of years in this business, but way back. I mean, this was 2015 or so when we're looking at apartment deals, and rates were flat, not going anywhere, and they didn't move anywhere for years. But we still did fixed rate financing. Could we have gotten better yields or better terms on floating rate? Mm-hmm. Sure. Now we did do some bridge to perm, but that was all like short term bridge to putting on like a HUD 223F that was going to last for 35 years with a fixed rate, fully amortizing.
And that's the conversation that we have with investors is, the multifamily syndication space is quite saturated. There's all sorts of groups out there that, can piece together a deal and go out and acquire a property, can they do it appropriately? Can they mitigate the risk up front and control the controllables up front upon acquisition like we do at Great Capital? It's been proven that not everybody can. And so with those investors, when we have conversations, it's amazing how far it can go to just mention some of the risk mitigation principles that you and Jay and Great Capital that we deploy in our underwriting. And when we actually go to originate new debt, or if we're assuming a loan, if it's floating rate, there's always a cap. So we're trying to control any risk that we potentially can in a project.
Yeah.
Where I think that there's some groups that otherwise got involved in projects that maybe they knew about the risk or thought that maybe they had it under control.
Yeah.
But the situation just kind of spiraled out of control on them.
And that's okay. That's okay.
Yeah.
Again, like not every deal is going to be successful. Like no one can be perfect, and everyone's going to make mistakes. It just let's let those mistakes flush out,
Yeah.
and so people can learn from their mistakes,
Correct.
and the market can learn from our mistakes, and we can do better next time.
What do you think the multifamily syndication space looks like in, let's just call it 3 years, once this maybe is all flushed out? I mean, there's
That's a great
obviously
question.
operators that will no longer be around, but I've read several articles on, I don't want to call them bad actors, but
Yeah.
groups that have otherwise put together deals that came back at 100% losses, that have essentially just changed their name and began raising capital again. It's like a camouflage, hiding their past.
That's a really good question. I think there's going to be some maturity because there are groups like Great Capital that were born post 2012, post Jobs Act, where we've done online advertising and kind of born this kind of middle market syndication space that have again, just using Great Capital as an example, we've matured in a way going from, starting off on partnering with others, doing co-GP deals, to doing our own syndications, being a lead sponsor, to starting a property management company and construction, doing more and more and more ourselves. And then, as what we're still doing, building the, institutional, systems and best practices and trying to grow in the right way and continuing to build that team. I'm just using this as an example. There's other firms like us that are in 5 years from now are still going to be around. I think they made some good decisions and are going to be able to command some market share. It's an extremely multipolar space, given geographic dispersion and concentrations, and again, you can be a huge player in a state or a market, and someone in another state or market has no idea who you are.
Correct. Yeah.
So it's a big industry. So I think there's going to be this middle market, upper tier middle market of firms like Great Capital that have been around for a while and have kind of figured it out. I think there's always going to be that other part of the lower middle market, and then even kind of the startup syndicator world that is going to continue to percolate, and new folks are going to always going to be emerging, because these opportunities in real estate, there's a cycle. But you can go back any decades, and there's people who are trying to break into real estate in general.
Right.
And real estate syndication, wasn't as popular in the 80s, 90s, and early 2000s because you really couldn't do it in a way you could not do it in the way that we do it today. You kind of were stuck to the country club model of, it's like, I can only raise money from people I have a substantiated relationship with. Or at least from non-accredited investors, and even accredited investors, you're supposed to have to I've established this relationship,
previous interaction.
I'm not going out and soliciting new money. But there's going to be firms that start up, syndicators that I'm just throwing stuff out, that maybe are more lightweight. Maybe they're completely AI native, and they're they have all of these systems built out, and they have asset managers, or maybe they're just great marketers, or I don't know, they just have a different style about it. But there's always room for that. There's always room for somebody to say, I've got an idea, I've got some experience, and I'm starting a new business. I'm going to go out and buy multifamily, because just the business case makes sense.
Yeah.
So I think it's going to be slightly more mature. There's going to be some folks that are still around after they're going to reinvent themselves.
Yeah.
And that also happens every cycle also.
Sure it does.
I can think of several firms, and the ones that are able to make it through that, as much as I'd like to dog on my competition, the ones that make it through that successfully often are better for it on the other end.
You better have learned something for sure.
You better have learned something. I mean, I can think of a large. I'm not going specifics on the name, but I can think of a large commercial real estate group here in Indianapolis that went through bankruptcy, around the great financial crisis, lost pretty much everything, and we're doing projects across the country, industrial, office, multifamily, you name it.
High exposure,
and it was just levered to the tits like everything was, and it all blew up, and they had to figure it out. But they figured it out. They had to make some tough decisions, and they had to kind of like build things back up and back to doing here's a multifamily deal here,
right,
and another multifamily deal here, and maybe one project over there. Right. They built up the confidence. Again, kind of had to start from scratch. They've had the name, but they had to start from scratch, and they've been doing great deals and big deals and doing good stuff in a managed risk way.
Best foot forward with a new lease on life and some lessons learned. We've already seen what the distress and I would just say in the multifamily space has done to our capital raising efforts. And we've either heard, seen, felt, observed prospective LPs kind of mention a hesitancy or tendency or an inability to invest in gray capital because of some negative experiences in the market elsewhere. How do you envision, if this distress kind of does come to maturity and there are losers in this scenario, how do you envision some of these LPs that are otherwise taking, their common equity losses? Is there a time horizon upon which they get back on the bike?
Some will, for sure. Some never will. I think from the psychology behind it is, it's easy to just write it off and blame it on the asset class, the timing yourself, and just like I didn't have a good experience. Why would I try that again? How would I do that differently? Now there's other people, and I don't know what the breakdown is, but there's other folks that are like, okay, well that's what happens when you invest at the top of the market, and I didn't know that then.
Right.
But in retrospect, I wish I would have invested a couple of years earlier, or I would have waited to invest now. And there are some people who we talked to our LPs, and they're like, I'm just continuing to, that was peak of the market, but I'm going to stay focused. I'm going to stick to my plan.
Yeah.
And those folks that are like still open to it are like, I'm really excited for this vintage right now. These deals should be really good. It's hard to like point to all the reasons like why. I mean, but like feel very good about this vintage of deals and opportunity. And it's not going to become, the data, is still showing that it's going to be slow right now. But there are still big bids out there for these assets. People are going after them. The assets aren't going to be cheaper when all of a sudden we have that big spike up in growth, which will take place at some point. Could be 2 years from now. But when we start seeing that growth and that lift, that's not a like quantifiable, underwritable like period of time of where you're going to buy it and then we're going to see this little blip up in growth.
Yeah.
I mean, you can try to model it in like with your average, but like, it's hard to take into account. So, but you have to like buy it before that happens. You can't buy it after that happens. You got to buy the rumor.
Yeah. What's the equities? It's like just time in the market, right? So just if you had a bad taste in your mouth from a sponsor, wash your mouth out and go again, get that taste out of your mouth.
Yeah.
But not everybody has the ability or the conviction to do that, or just that kind of the persistence. So,
well, yeah, I mean, I think there's a scene in the show Billions where they're talking about, trading and how it takes a certain type of mentality to not just like say your trade was wrong, but then to take the opposite trade.
Interesting. Yeah.
Just say like, okay, not I thought this. But not only I'm not just going to say that I was wrong, but I'm going to absolutely go in the opposite direction. And so in like the analog to here is it's like I just lost a bunch of money on this multifamily deal. Now I think multifamily is horrible. Now I'm going to take the opposite stance, and I'm actually going to I'm going to double down on that idea.
Right.
And I guess maybe the direct analogy would be like shorting a bunch of shorting right now.
Yep.
Which at that time probably would have been good, but now you're kind of past that point in time. So I don't know if that makes sense as an analogy or not. But we're at a peak. This you would think that we would be seeing more discounts, but the reality is, and again, that's where I think we all go is that okay, there's going to be some discounts. The reality is, we've just been discussing, there are so many folks that want to buy at these these assets, especially in the markets that we're going after. That it's just the opportunities aren't as attractive as you'd like them to be in an environment that seems risky. So you're not really getting the risk premium. But I also believe, because this is what I think, is that investors are going into multifamily right now because they see it as a relatively safe asset class. Again, it's like, okay, well, maybe we don't get as high of rent growth. And it's really only disappointing if you're like, is it going to hit that 30 IRR like those other deals did?
Yeah.
If you don't need it to do that, and if you don't need it to be a 15, like for sure.
Yeah.
And you're like, I want to not lose my money. I want to get some tax sheltered income, and I'd like to see some kind of multiple. Let's shoot to double it over 5 to 7 years. Mm-hmm. If you have any kind of flexibility, it's a great place. Just pricing as it is today.
Right.
But if you're looking for 16, 17, 18 IRR and more than a 2x over 5 years and a 2.5 over 7 and 8%, 9% cash on cash return, I mean you're just not coming up with much right now.
Right.
And that's just the reality of the ground.
Right.
I mean, a lot of other people think it's attractive.
That is one of my favorite conversations or questions that we get when we're on capital raises. Hey, your track record, I see all these 20 plus IRRs. Why are you showing me this 17% IRR? It's like, well, obviously the under promise, over deliver component of our business plan is being enacted here. Also, just the market cycle, the vintage.
Yeah.
There's a lot of impacts, but people.
We bought it at a 6.25 cap, and then
Yeah.
it compressed down to a 4.5.
Yep.
That's how that happened. And then we had a year of, 15% rent growth.
Yeah.
Yeah. That's how we get a 30
Yeah.
IRR. Like we can't model that. Well, I want to take just a quick pause. I want to switch over to the jargon bin because we haven't hit the jargon bin yet. And it's key. And it's a good opportunity to break things up before we get into our last piece, which is about Gen Z renters. So this week's episode of the Jargon Bin is yield. All right, start foundationally.
Are we talking about the noun or the verb?
So it's funny when we talk early, both. Yes,
That's good.
yes,
That's great.
So yields. So first I was like, when we're talking about yield, it's very straightforward and simple, you'd think. But there's so many different ways to talk about yield. Mm-hmm. And that's a perfect candidate for the jargon bin. So provide a little bit of clarity of what the heck are you talking about when you're talking about yield. What's the yield? Well, what kind of yield are we talking about? And then so Griffin and Jay Reeder, Chief Investment Officer, we were talking about earlier today. It's like, well, a farm yields crops. Is that kind of the origin story here? And thought that maybe we should start talking really foundational, beyond even investment. So yield, output relative to input. Mm-hmm. Anchor with, so 3 non-finance examples would be, again, farm, crop, yielding crops. It's the output from the land. Your strategy, it yields results. It's output from the effort or driver, like literally you're on a car. And this is where we were joking, we're like, well, how do you connect the yield sign on the road to a bond that is putting off some yield? Yeah. And what it comes down to is that it's the giving away. And so when you give deference to that other vehicle, you're yielding. Or if the bond is yielding, giving to the investor, it's that same process of giving, yielding, or getting from. In a financial definition, it's the income an investment produces expressed as a percentage. A simple example is in $1 million invested, $70,000 a year in yield income. That's a 7% yield. Mm-hmm. We would also call that a 7% cash on cash return.
Right.
In this context, it's the same thing. It's also kind of like, but is not. Well, cap rate is a yield. It's a type of yield. Mm-hmm. Again, we're using kind of the same equations to talk about similar but different things depending on the context.
What are the two, I guess, most important variables when you're thinking about yield? Because the way that I think about it specifically in investing, and let's just bring it back to multifamily, is, what's your basis? What basis are you starting off of to generate the percent yield?
Yeah.
And then there's a time frame component to it, not a time duration, but you can have an annual yield, you can have a monthly yield,
that's
you can
true.
have a full investment yield. So I guess what are some of the variables that you think about when you're trying to equate, or maybe more specifically, because yield's more of a category, it's less of a single metric.
True.
So yield, there's a category of specific metrics that would fall under yield. And so I guess when you're thinking about yield, those two kind of variables of what your basis and the time duration, how does that change the way you look at yield?
Yeah, so really two main, I think, components there to unpack. One is like, what are you basing it off of? What's the denominator in the equation?
Yes,
because
denominator.
it's like your income divided by what you have in there. What is your basis? And off the simplest way is whatever you put in. At some point I invested $1 million, so I'm just not gonna. It doesn't matter what money I get back or changing of whatever capital accounts are going on. Accounting. I've given you $1 million. How much money am I getting back? And I'm going to divide that. Whatever you're giving me, I'm going to divide by what I've put in. Now, then the time duration, the second piece. So if you have monthly distributions, let's say, and I get, I get $1,000 from my I've invested $100,000, and I get $1,000 1 month. What's 1 over 12? It's less than it's not that large of a return. But if I annualize that, if I multiply that $1,000 by 12 and I have 12,000, then all of a sudden that's a 12% yield. And so typically when you're looking at a pro forma, you're looking at an annualized return, not necessarily a monthly return. And so what often happens, which is the nuance is important, is when you see that like your distribution represents an 8% annualized return. Well, if it's a quarterly distribution, that means you've received 2% on your money. But we're saying, at this rate, if we trend this rate at an annualized rate, it would equal 8%. But that doesn't necessarily mean your annual yield will be 8%, because you can get 2% one quarter. You can get 2% the next quarter. You can get 0% the next quarter. 0% the next quarter, and then you've got 4% actual annual yield. So that would be the difference between annual yield and annualized yield.
So when I first got introduced to Gray Capital, we were amid the Gray Fund capital raise.
Yeah.
And I believe the preferred return on the Gray Fund was an 8% preferred return. And minimum investment $100,000. I was like, why would anybody not do this? You're going to give me 8% return every month.
Yeah.
That's incredible. I'm going to make $8,000 a month.
Yeah.
For 12 months. I'm like, I'm going to get my money back so fast. This seems like, and then I learned very quickly, and I remember the day that I learned very quickly, that was an 8% annualized preferred return rate. And it's very important to understand that as a base level investor, of understanding what that time horizon, what that kind of time bracket is around that yield number, because it can quickly your eyes can get big and get a little greedy, and it's like, holy cow, this is a great investment.
8% every month.
Now, 8% a year is not bad, but 8% a month is outrageously good. Everybody would be doing it.
Yeah, exactly.
Maybe that makes me seem a little foolish and naive when I first got started.
No, I think that's a very honest and common take of what happens a lot. And anything preferred return, there's a lot of confusion around just preferred return. Just digging into that, because it's appropriate. A preferred return is not a yield. You can be yielding at the same rate as your preferred return. Your yield can be generated by your pref, but your preferred return itself, I would not consider a yield. It's a hurdle. It's a priority. And so again,
the yield could be less than or greater than the preferred return.
Exactly. It's a component. It's an economic structure. I mean, go watch the whole preferred return jargon bin where we go into detail. But I think all that's a really good point.
So I've just got, again, I said yield's not simply one metric. It's a category of metrics, and we have listed in the notes, cap rate, cash on cash, and yield on cost. Yeah, all being kind of quantifiers of or metrics of yield. I want to kind of double click on the denominator and basically the basis of the calculation of yield, specifically in just kind of talking about maybe a cash on cash return, with the denominator being your current capital balance or original capital balance.
Yep.
We've talked about that in our cash on cash
Exactly.
return jargon bin. And then I want to go to yield on cost, because I think that is a really solid metric to understand in regards to real estate investing, because it will appear to be a little bit lower maybe than somebody would think based on overall cash on cash, or just because there's all-in costs that other people are maybe unaware of initially as they start to jump in. So talk about the yield on cost and how that kind of adds up, and why it may be a bit lower than the other yields in a project.
Yeah, so yield on cost, first off, like, it's cost, not purchase price. And that's where, we diverge from like cap rates, where like cap rates are on like the purchase price. But we all know, if you've ever bought a piece of real estate, like, your purchase price is the vast majority of the costs associated, but there are other costs. There's transaction costs, there are fees, et cetera. If you're doing a rehab, if you're bringing on, millions of dollars, that's all part of the cost. And so price and cost don't equal each other. The cost is typically significantly more. And so a yield on cost is all right. So all the money that we're going to put into the deal, like, being realistic, all the money that we're going to put into it, what is then the yield after that? And again, the income is like the cash that is generated, relative to the entire cost of the project. Now, yield on cost, so a lot of folks they're looking at a stabilized yield on cost. Again, you can just look at yield on cost. What's our year one yield on cost? What is the cash flow? What's the net free cash flow that's produced relative to our total cost of the project? Then there's stabilized yield on cost, which some people will just call yield on cost, and that's fine. And that's when you're looking at your stabilized NOI. Go back to last week's jargon bin episode where we talk about stabilized. And in this case, it's your business plan is stabilized. And so, you've fixed up the property, you've moved rents, you've hit your pro forma. And this is often in year 2 or year 3, and you're taking that stabilized net operating income and then dividing that by the cost. Because that's kind of where, like, all right, we've done all the things, we've done the lifting, we've pushed things, and now it's stable and we're going to maintain. Based upon all the money that we put into this deal, if all things go relative the way we want it to, what is our yield going to be at that point? And that's what a stabilized yield on cost is going to tell you. And it's a great metric, because I think it can be a more accurate representation of the deal in the business plan. What it ignores and assumes some things, though. It ignores the path it takes to get there.
That front end adversity or
and things not always going right. So it ignores the process to get there, and it assumes that you will get there.
Right.
And that yield on cost is a sure thing. And I think that it often, like, you will usually get there, not always, but it's the duration. And so again, you're saying it's going to take 2 years to get to a stabilized yield on cost. I've seen operators pro formas that have their stabilized yield on cost take place in the first year of operations. And sometimes it is mathematically and physically impossible to achieve that stabilized yield on cost in the time frame which they are proposing. And a lot of that's because of like lease expirations, etc. So yield on cost can be great, but again, it just takes a little bit of nuance to understand what we're talking about.
The category of yield, there's a lot of different ways to take a look at it. And it gets maybe confusing to some folks as they're looking at, when we mentioned cost of capital earlier, when you're looking at a deal and the relationship between its ability to yield, whether it's in year one or it's the stabilized yield on cost, and your cost of capital, how do you determine what makes that deal work? Because the yield must meet your cost of capital or exceed. So there's a bunch of levers. Which one of these yield metrics do you utilize to kind of say, hey, this deal is going to pencil to not only cover your debt service, but also the cost of capital?
Well, that it comes down to understanding your cost of capital, or not even the cost, like who your capital is. And are they in that scenario where we're talking about yield? We're typically talking about investors that prioritize cash flow and income, and less total return. Although total return is almost cash flow and total return are always relative. They're always part of the conversation. It's rare that someone cares nothing about the IRR or the cash flow. I mean, occasionally, but it's typically, hey, I'm okay with lower cash flow early on. I'm more focused on the total return. I understand it's going to ramp up. Or you'll have some investors who say, I'm really focused on the cash flow here. Obviously, I'd like to get a good multiple, but this is income for me, and so I'd like to see some strong cash-on-cash returns, or a good stabilized yield on cost. But I don't want it to be necessarily too high or too aggressive, because my confidence in achieving that is less and less.
Okay.
So the cost of capital can change, but I think it's nuanced of what part of the return spectrum it is. Someone who is focused on yield it may be a lower cost of capital, because look, we only need to get an average of 7%, yield, and then if we can get some upside total return that's higher than that, then that's great. Or they'd say, hey, look, 12%, total return, but the cash on cash, most of the return comes through operations and cash on cash, and you're saying we're not going to be able to sell it for, we're basically going to sell it and get a little money from the proceeds of the sale, but since you're assuming in this example maybe a high exit cap rate for whatever reason, but that's okay. I'm a cash flow focused investor. We're just going to cash flow the thing, and then we'll hand it off to the next guy and make a little tiny pop, but which is very different from there's not going to be a lot of cash flow here. But then when we sell it, because we're adding all this value, we're doing something, then we're going to this massive pop, and we're going to extract all the value at the back end. So going back to your cost of capital, it's who that capital is and what they're really looking for.
What they're looking to achieve. It's trying to align interest with the project, with the deal, and making sure that the investor, the capital allocator, aligns with what this deal can actually provide.
100%.
I guess discuss with me a little bit about when you do see maybe a higher yield in the market. What is that market typically telling you in regards to that investment? Is there higher perceived risk in a project that's kicking off higher yield? Is it lower risk? Is that asset underpriced?
Risk equals return usually, and yield, high yield almost always means higher risk. Not that there can't be some exceptions, but if it is anything of note that anyone knows about, there shouldn't be, because again, we don't live always in a perfect market. But if we did live in a perfect market, equal number, kind of buyers and sellers, plenty of liquidity and all that, it's going to be that yield should be priced perfectly to the amount of risk, and risk should equal return. So in a perfect market, which we don't live in, but in a perfect market, risk is going to equal return. So if we're assuming that we're living in a near perfect market, if you see a high yield, that also means high risk. I mean, that's why it's very simply laid out when you look at different types of credit ratings and the different yields that those credit ratings put off. So a high yield and grade, a high yield bond is something that the market is perceiving as lower grade, higher risk, and so it's going to give you a higher return. This company is new. They don't have the track record that Apple has. They don't have the balance sheet that Microsoft has or Amazon has. They're a startup. They may go belly. Maybe they're really good, but they may go belly up. They're not as strong. That's why the U.S. Treasury, you're buying from government bonds, they're the risk-free rate. That's why they call it the risk-free rate is 4%, or whatever the 10-year Treasury is. And so any other yield on top of that is your risk-free rate. You take your yield, how to calculate, risk premium is you take whatever the yield is and you subtract it by the risk-free rate, which is the 10-year Treasury. So if you got a 10% yield minus the 4% on the 10-year, you've got 6% of risk premium. If private credit is the key example right now. People were lured into these private credit funds or all these private credit opportunities because they saw these high returns. And a lot of baby boomers are like, I need income, I'm retiring, These real estate deals that I've been investing in, they're no longer producing 8, 9, 10% cash on cash return. They're producing more of 6 and 7% cash on cash return. And I was using those for income, and I'd really like to get 10% cash on cash return. Yeah. Well, along comes a private credit fund or private credit opportunity or preferred credit in the real estate world. And they're like, I got you, bet 10%. No, I've got you 12%. You want 14%? 16% yield, I can hook you up. And so people, and all at the same time, those sellers, sponsors of those types of products are saying, and it's low risk.
Yeah.
We're just right behind the senior lender. Yeah. We've got the common equity that's behind us. We're in a priority position versus the common equity.
Yeah.
So it made the common equity deals like, why would I ever take that kind of risk? The reality is that common equity has been dead and gone a long time. That's that. Like, so you are all so that line has fallen off the cliff. It doesn't exist. You're standing on the cliff. You're the first. You're the next one to fall off.
One to go. Yeah, for sure.
And so, and again, if everyone thought that it was such a low risk investment, everyone would be like, "I'll hand you preferred credit. I'll hand you private credit." And so you'd be able to compete. That sponsor would be able to like shop it around and be like, well, you're offering me 16. That's expensive.
Yep.
You're offering me 14. I'll take the 12.
12
Lower cost of capital. That's going to work for my deal. But with that lack of competition, the providers can charge whatever they want. And so that shows how desperate the sponsors were. And that's why all these concerns about private credit, the same thing happened in real estate across the industry. There was a flush of cash because all the boomers were like, I need to replace that income.
Right.
All the RIAs, wealth advisors are like, bet I got you. I'm going to hook you up with some of this yield, whether it's Blackstone, KIR, or my buddy's got this new private equity fund. Hey, we're going to invest in all these preferred equity deals. We're going to do secure positions. It's going to be diversified, all this BS that sometimes happens, sometimes different. And then they had to go out and find these deals. And what they thought they were going to be like, oh, these were fine deals. They just needed a little bit of extra little capital here and there, push it forward here. Businesses, they're fine. What they found was garbage and like absolute like dumpster fires. And they had this massive pile of money. And they're like, well, if we just throw enough money on some of the dumpster fires, maybe we'll put the fires out. And then like for a while, like there was no smoke and it's fine. And then all of a sudden, like you see the little bit of smoke, it starts like smoldering and then it's like it's all wiped out.
Yeah, the prep's gone.
And that's where people are concerned. And so we've got all these a lot of redemptions going on. Maybe that's next week's Gray Report episode. Is maybe like the private credit, preferred equity, some of the redemptions. It's not exactly a real estate story, but it's going on in real estate also. So sorry, that's a long tangent on your question of higher yield, higher risk. But
I think I want to put this out there. When yields compress, values go up. When the yields are expanding, the values are going down.
Yep.
That's just the pricing in of the risk.
Yep.
Okay. And then the last question that I have, I want to talk about just the durability and authenticity of a yield that you see in a project. Our notes, we've kind of discussed this. You were throwing out some really high percentage yields, 10, 12, 14. You might see a 7% yield and think, oh, that's pretty solid. It's palatable. I'll take it. How do you know if a percent yield is inherently good or bad? Or how do you ensure its durability?
Yeah. So I don't think there's any such thing as a good or bad yield. I mean, I guess at least in like a pro forma context, I mean, I think after the fact, you can say that was a good yield.
Sure. Once it's all said and done.
Once it's all said and done.
I think that's fair.
But, I don't think inherently, forward-looking pro forma basis, I mean, it can be relative, but then again, the durability, like how can you sustain it and how can you get it? I mean, there's part of it is what's the difference between where you start to where you end, where you moved it to, because for like, each standard deviation, of like change, like you're going to there's a spectrum of outcomes up or down. And so there's a lot of things that have to happen to achieve that. It's the totality of all of the assumptions in the business plan.
Right.
I think that, if you can put together a pro forma that has a certain yield where everything has to go right and, the market has to turn around and everything has, you have to change the operations, you have to fix stuff and, it's dependent on so many variables and it's a highly complex. Or our highest yielding project was not complicated. It was buy right, finance right, and reduce concessions in a few expenses. And it's the highest yielding deal. So, but that at the time, was bought like in COVID, and everyone wasn't perceived as necessarily durable.
As an investor, you're trying to essentially kind of solve your own equation, right? You have your goals, you have your targets. So if you're an income targeting investor, you need to replace a certain number of dollars per year. You're obviously taking a look at where you can put your money in order to achieve that. And so the 7% that we have in our notes makes a lot of sense. You see that there's all sorts of different tools as an operator that we can use to bulk and or protect the durability of that yield. So interest-only periods in financing, it's a great way to boost yield in the first few years. You have a 2 to 3 year interest-only period. The yield in those first 2 to 3 years will be significantly higher than once that IO period burns off. A refinance to those assumptions used in a refinance, whether the interest rate's higher or lower than your original debt you placed on the asset, that could also materially change the overall yield following that refinance. So I just think as an investor, taking a look at your goals and then diving into the assumptions, like you mentioned, there's a long list of assumptions that can change the overall outcome of an annual yield. So it's just getting a better understanding of what is actually producing that yield and what factors in that equation are ultimately having the biggest impact.
Yeah, no, 100%. What are the assumptions that lead to this?
Yeah.
And then you're not judging the. Well, I think you and I sometimes see investors do. They judge the number,
right,
rather than the
on surface
assumptions
level.
And the inputs. Yeah,
on a very
just
surface
that
level.
seemed. It's like that yield seems aggressive, or that rent growth seems aggressive,
right?
Without being what's the what makes that up? What are the assumptions that are driving that?
I think we had a 7% preferred return that we were marketing. I think it was Solana, and it was amazing how many investors would jump in on a call or have a meeting and just be like, "I'm seeing 8 everywhere else," and I'm like, well, did you look into why you were seeing 8 everywhere else, or do you want to spend the time to discover why we're marketing 7 for the potential to grow up to 9, 10, 11%?
You're not investing in 7%. I mean, like that. That's like saying like I'm investing, and people do this. I guess it's like I'm investing in deals that will have a 1.5% asset management fee.
Yeah,
I'm investing in deals that have a 3.5% property management fee. Obviously the totality of fees. I'm not saying that doesn't all matter, but like, well, what are you getting? What's the goal here? Or again, are you trying to generate income? You're trying to diversify. You're trying to grow, like tax benefits. Like what's that? Like, let's talk about that stuff. Yeah. Not like.
And what are the priorities of those goals? Right?
What are the priorities? But it's not just one. Okay, we got to move on to this rent cafe piece. Gen Z housing hotspots. Gen Zers who are, we looked this up before. Let me see if I can find the tab. I probably have lost it, but basically Gen Zers, I've lost the tab. Anyway.
It's like 1998.
Oh, I've got it. Yeah, exactly. 1997 to 2012. They are digital natives focused on activism, social media, and on-demand tech, whatever that all means. Okay. We all know Gen Zs, where we can, anyway. Not to be confused with Gen Alpha, which is 2020s to mid-2020s. But, okay, we've got this piece from Rent Cafe, and it's basically laying down where all these Gen Z folks are moving. Southern Metro's lead in renter growth, while buyers turn to the Midwest. And I think that's an interesting part of this piece. Is not only talking about renters, we're talking about Gen Zers, which we think about as like college kids or younger, but the reality is my sister-in-law is Gen Z and she's a doctor. So that's who Gen Z is. They are entering household formation years. They are getting married. They are having kids, at least on the older side of things, and they are thinking about these housing decisions. And it's that point of the life. So Griffin, you are a millennial. You're not a Gen Z. You know some of them.
The overwhelming theme and the overarching
Who are these?
theme.
This is Gen Z. What is this? Beanies? What is this? This is like 1996 who is this? Who's the beanie guy? Why are these shorts are like that?
That's not how you carry football. by
and
the
that's
way.
and are these? Who are these? I'm sorry.
not how
I
you
do
do it.
not mean to get caught up on this image. It's not
Yeah.
the most important thing.
High and tight.
But what are these people wearing, Griffin?
I don't know.
Okay, sorry.
Good question.
Continue.
That one lady's wearing a scarf.
I've seen this. This is not the first time I've seen the article, by the way.
The overwhelming general theme of this is just a pursuit for affordability. They're buying homes in the Midwest and they're renting where the supply is the most profuse. in the South.
And is that because they want to move to the Midwest to buy, or is that just the only part of the country where you can buy?
I think it's affordable. I think the cost of living is low. I think it's a great place to start a family.
Yeah.
In order to raise
Yeah.
kids. Now we're biased, obviously, but then if you look at where they're renting, very similar thing. It's in very supply saturated markets where I am sure the rent growth is. I'm sure there's concessions wild and rent is trending negative. So
Yeah.
it's a pursuit.
Even in
of
Lafayette. I mean,
affordability.
again, Lafayette is like they've had Indiana, which we're surprised to see. But there are one is obviously it's a large college town with Purdue University. But there's been a lot of supply that's been built in Lafayette. I mean, actually, like an insane amount of supply. I don't know if that's the reason.
Work from home, totally fully remote workers, trying to increase their overall income, spend
Yeah.
as little as they can on
Yeah.
housing, and live in an affordable, nice place to live. That's the general takeaway from this article. That if I had to sum it up very quickly, that's how I would do it. But I do think some of these markets are quite interesting, especially if you look at California, San Francisco, San Diego. Can't blame anybody for wanting to move to San Diego. But some of these markets are not super affordable cost of living markets in regards to grocery costs, gas costs, all of these different things. But California's got a nice saturated cluster of markets.
Part of this article, I don't think that they're not purposely misrepresenting anything, but it almost seems like there's just a lot more Gen Zers that are either renting now than there used to be, because it has this like 2018 versus 2023 statistic. And I think a lot of that is just because they are actually now in the housing market. Like they're out of, that's just them getting out of their parents' house.
Right.
Because I think the stat here that it starts with is that in just 5 years, the number of young renters reached 4.4 million from just 700,000, making a six-fold surge that's redefining hotspots from Birmingham, Alabama to San Jose, California. The reality is, it didn't. There were actually more young people 5 years ago. They were considered to be in the millennial generation, and this is just talking about the Gen Z generation. So I just, the first time I read that, I thought it was confusing, and I think it's important to note that the Gen Z demographic is actually smaller than millennials. So to say that like there's been a shift of new young renters, there's a shift in there are more Gen Z renters. That's like, again, like saying like young home ownership has increased by a crazy percentage point, and ignoring all millennials and saying, yeah, for Gen Zers, because they were all like 14 years old and they didn't own homes when they were 14. Now they are old enough to own a home, and now more of them own homes. So, and it's going to be a step change when you go from 0 to any number.
Without scrolling down, take a stab at, and I know you've looked at it already, take a stab at the number one market for Gen Z home buyers.
Okay, renters. We got to find the right graph.
It is
Almost. Okay.
Ogden. Well, I guess it's on their map. Maybe I'm looking at the wrong map. Ogden, Utah was the number one top 20 hotspots for Gen Z homeowners based on their chart there. You found it. That's just north of Salt Lake City, so potentially it makes sense. But I've never heard of it. Well, maybe I not have heard of it, but
yeah, I mean, it's pretty. I mean, I don't know the story of that. Yeah, maybe there are. I don't want to make any Mormon jokes, Griffin. So I'll let you do that.
Right. Yeah, never heard of Ogden, Utah.
Don't make any jokes like
I'm
that.
I'm sure it's beautiful.
And it's an interesting one. I mean, but Louisville, Kentucky also has a lot. Again, these have like 40% of Gen Zers own a home, that is insane. I guess I don't know what.
It's the money out there.
Sensitive.
Yeah. You're
Yeah.
young. You come from a wealthy family. You want to live close to home, and these big families, they all, they're just setting up shop next door to each other. Parents buy you a house.
I don't know. I guess. I guess. Yeah. in this community.
40% is extremely high.
That's just really high. I mean, that's double. I mean, I guess Jackson.
It's pretty high too.
It's also, again, it's relative to where homes are somewhat affordable, and so that is where you definitely have a concentration.
I'd love to see the average home value between Ogden, Utah, and Jackson, Mississippi.
The home value difference.
Yeah. I've got a sneaky suspicion that the home value in Ogden, Utah is somewhat higher than Jackson, Mississippi.
I think it is probably too, but it all depends on how rural Ogden is. I mean, if it's, I don't know anything about Ogden.
It looks like it's like 30 to 45 minutes north of Salt Lake City,
so it's
but
like a suburb.
I could be totally wrong.
Okay, I don't. So
just interesting to where these kids are choosing to set up shop and move and buy homes and rent.
But I could get back to this. Other than really, I mean, I guess Riverside, California, and even Fresno. But even Riverside and Fresno, these are more inland California markets. You really don't have anything coastal. I mean, the only thing that's close is Jacksonville, which, Jacksonville is in Florida and it is coastal, but again, it's a little bit different from, Miami or Tampa. What I'm saying is these are generally more affordable, and I would consider Jacksonville more affordable markets. We're talking about Wichita, Kansas, St. Louis, Missouri, Louisville, Omaha, Detroit. These are little Cincinnati, Birmingham, Greenville. It's starting to get a little more expensive, but still historically affordable. Winston-Salem, Columbia, South Carolina, at least historically affordable. Harrisburg, PA, Pittsburgh, PA. I mean, these are Grand Rapids. These are affordable metros. And where I think what this article is also saying is, again, you're getting some of these Gen Z folks, these adults now, and eventually also the Gen Alpha, which is the next cohort to come. They are going back to the beginning of this long podcast, Griffin. They're thinking about their life and architecting their own life and being intentional. And, they're looking out some, not all. They're saying, do I ever want to own a home? And where do I need to go to be able to do that? And you've got a lot of options. But it's probably not going to be in Los Angeles. It's probably not going to be in San Francisco. It's probably not going to be anywhere on the eastern seaboard, like on the East Coast. It's probably going to be in the Midwest, maybe something kind of more rural in the Sun Belt. But like you got to, it's just a different mindset rather than I'm going to go YOLO in Miami.
Right. I was just thinking that. I've been reading some articles on how the home values in Florida are actually trending the most negative out of the nation. Just there's an overwhelming amount of supply.
Yeah.
The new homes construction, the builders are taking a reduction in their overall purchase price. It'd be interesting to check back on this as history kind of proceeds and just see how these markets are changing based on supply and demand.
Yeah, I think a lot of them will change. I think we've already seen the Sun Belt in many cases. If it weren't for supply, the rents in the Sun Belt would be really high, and all of a sudden not nearly as affordable as it once was. It's not as affordable as it once was. Supply has helped that.
Right, and in the renters map, the state of Texas, well, we saw it earlier in California, but Texas has got a nice cluster of markets where they're setting up shop, and I don't think that's any surprise. Austin's on there, Dallas is on there. I believe that's Lubbock out west, but just they're headed to where I feel like the affordability is based on supply and demand. There's a lot of college towns too, which I think is interesting. Fayetteville, Lafayette, Gainesville, Austin, College Station, Lubbock.
All right. Well, make sure you signed up for not just you subscribe to the Gray Capital YouTube channel, but if you are all interested in multifamily investing, you like these types of reports, we send out a weekly newsletter. We've been doing it for years now, many years, since COVID basically. It's called the Gray Report Newsletter. You can sign up. GrayCapitalLLC.com/newsletter, or just go to the website. It comes out every Thursday, 8:30 Eastern Standard Time. It's packed full of the latest research reports, data, articles, and then maybe a link to the latest episode of Gray Report. We're not allowed to say who's all to subscribe to the Gray Report newsletter. Let's just say a lot of your news sources that you are probably getting information from, they get a lot of their information from the Gray Report newsletter. Globe Street just did a whole piece on the Gray Report this last week on one of our episodes related to kind of a slowdown in rental traffic. And thank you for Globe Street for that awesome coverage. But if you want to get that information first, You don't have to wait, 2 weeks for Globe Street to write an article about it. You want to be, on average, we're about 2 to 3 weeks ahead. Like, not to, obviously we're getting our information from somewhere, but we're aggregating it before it gets all put together in a nice tidy bow for you by some fine media outlets in the future. Get it first here, go direct on the Gray Report. Whether it's a newsletter or you're getting it from the podcast, Griffin and I will be here to keep you up to date. Any closing words, thoughts, remarks, Griffin?
Be the architect of your own life.
Oh my gosh.
There you go.
Be an architect of your own life. Thank you. We'll see you on the next one.